This podcast is for informational purposes only and does not constitute financial advice. Opinions expressed are solely those of the hosts and the guests. Please do your own research or consult a professional before making investment decisions.
Welcome to Unblocking the Chain. I'm Drew Bradford, the CEO of Macropod, and I'm joined by my co-host, the CEO of Jelly Sea, Michael Critter Prendeville.
Drew, great to be here, and all I'm going to say is 5-1 and second on the ladder. That's all. Back to you.
That's perfect for about 0.1% of the whole world that cares about it, but, world famous in Perth. Perfect. Today, we are joined by Mike Reed, Senior Vice President and Head of Digital Partnerships at Franklin Templeton. Welcome to the show, Mike.
Thanks a lot. It's great to be here with you.
Franklin Templeton got into the digital space very early. Love to hear how Franklin Templeton actually got into the space. Did everyone think this is a great idea, or was there wrestling internally with the space? I'd love to hear the beginning of FT's journey.
Sure. The very beginning of it was years ago. We were all sitting on a fixed income trading desk, and someone came in and he said, Roger Baston, who started our effort in the space. He said, my son was playing a video game and won a tournament, and he got paid Bitcoin as an award. Does anyone know what Bitcoin is? And we were said, no, what's Bitcoin? And that was about 15 years ago, and it started our journey down, the rabbit hole that is blockchain technology. So we kept digging in deeper and deeper. Ethereum launched, programmable money, all these things kind of resonated with us. And then the secret sauce for us is that Jenny Johnson, who's our CEO, actually used to run operations at the firm. And so the idea of us being able to find ledger efficiency was something she was deeply passionate about, which is super rare from someone in her seat. So she gave us some budget to hire some developers, and we started building an on-chain transfer agent, a digital wallet infrastructure, and kind of we're off to the races from there.
Have you got any stats on how efficient the blockchain has made Franklin Templeton? So from a cost point of view versus a fund that's traditional, the cost of running a traditional fund versus a tokenized fund?
Yeah, I mean, I'll tell you that running a traditional fund, the key thing that maybe to take a step back, any mutual fund has two main ledgers. One is the holdings of the fund and one is the holders of the fund. And what we chose to tokenize was the holders of the fund, the transaction records, the TA component. And when you're recording those types of transactions in a traditional transfer agent infrastructure, it can be quite costly because transfer agents have big, monolithic databases they have to maintain. They've got large employee bases, buildings, this huge overhead of infrastructure. Meanwhile, to transact on the Stellar blockchain, which was our launch partner, I believe costs something like 0.005 of a penny to record a transaction. So basically it becomes free to run your transfer agent using this type of technology. And depending on which blockchain you're using, it can cost a lot more. But generally speaking, you can see massive cost reduction by doing that. And then the other benefit that you get is there is operational efficiencies that make the systems way more performant when they're run blockchain native. So for example, when we launched our product for the first year, we actually did run parallel book of records on and off chain. And over the course of that year, we did about 50,000 transactions, give or take. Across all of those transactions, there were 2 errors, both of which were in the traditional system side. I mean, one of the errors was the traditional system couldn't reconcile with the on-chain system because the on-chain system went out too many decimal points. In other words, it was too precise. That tells you this is performant. This is something that I can rely on. And then we pulled off of the off-chain system and have been running authentically on-chain ever since. So things like that are kind of, it's kind of like things where you're saying, okay, this is a better system. It's more performant, can be cheaper. Now, there is obviously some overhead in trying to build that system. So you have to think of all of the development costs and stuff like that. But generally speaking, it can be a lot cheaper to run your products on public blockchains.
The NYSE and NASDAQ are planning on tokenizing at the end of the year and running both systems, traditional system and tokenized system, in parallel. So you guys ran it in parallel for only 12 months. I have not seen a timeline for NYSE and NASDAQ, how long they're going to run the two systems. You got a guess on that?
Boy, I sure don't. But I mean, I'll tell you that something that became really obvious to us in the beginning was that when we launched our product first and, ran it and were able to build something we felt like we could sell to customers and offer publicly. When we started talking to customers about it, the market reaction was not a ton of excitement because, in some ways, a traditional money fund operationally can be really good for traditional businesses because it works with their infrastructure. Like they have treasury management systems, everything's all embedded. It just works. So we knew to get people, interested in what we were doing, we would have to append on blockchain native features to the asset to make it more interesting to people. So for example, one of the features that we added was that we accrue yield in our product by the second. So if I send it to you at 2:30 in the morning on a Sunday, not only is it authentically yours because the transaction records live on chain, but also you begin accruing yield for the day at 2:30 in the morning on a Sunday. So at the end of the day, I would get 2.5 hours of income. You would get 21.5 hours of income. A feature like that, which is only possible on blockchain, that's the reason why people want to go fully on chain. If you're not fully on chain and you have this kind of, shadow asset or like a receipt token or something like that, you're not able to unlock the full power of blockchain. So as those organizations are like trying to understand the timelines around when they might, may or may not go fully on chain, I think these are the kinds of learnings that you have where you say, okay, the blockchain systems are performant and allow for added feature sets that can benefit clients in the end. The thing that I just told you, what that's like this intraday yield idea, what it's allowing you to do is to fully realize the economics of your trade. So the owner of the asset gets this added benefit of no matter when they hold it, they get the exact amount of income that they're entitled to. Whereas the traditional money fund, it's like whoever holds it at market close gets the income for the day. It's different. It's those kinds of feature sets, I think, that drive adoption timelines and get people excited about this technology.
Oh, look, it's awesome. Like sitting here in Australia, like if I want to say I've got an equity portfolio and I've got an Australian asset that I want to sell to buy a US asset. So I want to sell something, some Westpac shares here and buy some Google shares in the States. That transaction now is about a 7-day process, right? They've got to sell the Westpac shares. Money goes to the bank account 2 days later. It then gets sent to the US, which is T+2. It's pre-funding my brokerage account in the UK in the US to buy the Google shares. It's literally a 7-day process. So that is going to be a big turnaround as more and more people adopt tokenization.
Mike, I've got a question. 2017, you really started the Benji development. It took to 2021 to actually launch Benji. My understanding is it's backed by US Treasuries. And that sort of fed through to what Jelly C is now participating in, and that is our funds are participating in the collateral mirroring program. Can you run us through the evolution of Franklin Templeton on the fund side and chat more about the collateral mirroring and how that's developing?
Sure, yeah, and we thank you for the partnership there. Of course, you're a key partner for us. One of the great things that we have at Franklin Templeton is a global distribution footprint, and so what we've done is we've developed products all over the world with this kind of Benji tokenized money fund construct, where now we feel like we've blanketed most of the world to allow investors to invest in these assets. Because the assets live authentically on blockchain rails, that alone lets them be ideal collateral for investors who are not trading on US market hours. If I send you an asset off hours and there is an off-chain book of records that is the authentic book and records of the asset, as the asset moves around in off hours, it doesn't really reconcile until the books open and then the reconciliation can occur. Because our asset lives on chain, it reconciles all the time. The settlement can occur at any point in time. So now if you think about that as an ideal asset for trading non-US hours, we look at some of the biggest markets that are happening. And of course, people who want access to assets like these tend to be more digitally native types of investors. So we worked in conjunction with OKX and Standard Chartered to develop a program where users can buy our asset. It gets posted to a wallet hosted by Standard Chartered, and then the balance of that is reflected on the OKX exchange for use as collateral and derivatives trading. We think maybe I can turn around and ask you why you like our asset, but our thought about it is that people like it because, the NAV of money funds tends to be relatively stable. Holding a dollar NAV over time is what they're aiming for. So, but unlike, like a stable coin can't pay out yield to investors where our asset can. So it all of a sudden becomes a good form of collateral for that reason. And then in addition to that, instead of using something like Bitcoin or Ethereum, there's no volatility to the asset. So as you're thinking about your margin account and managing it, it becomes a lot easier to manage that margin account than it would be if you had super volatile assets. When you have this asset, you start to think about it not just like buy my fund. You think about it more like a tool that can be used across a variety of ecosystems. And this project, which we're working on together, is really just one example of that we're super excited about.
So the reason it's so good is we can get in and out instantaneously, okay, and 24/7. So, and we can move our capital around and then interest, on an hourly basis or on a daily basis, however you look at it, it's very functional. So for us, we can also leverage off the capital. So there's a lot of goodness involved.
How do you see it playing out against, the traditional banking system? Do you see digital products such as stablecoins, such as money market funds that pay interest for the complete time? Are they competitors of the banks? Are they complementary to the banks? How do you see that challenging the deposit base of the banking system?
First of all, I would say that our assets, there's a Venn diagram of overlap between a tokenized money fund and stablecoins, where there is some overlap for sure, but there's definitely things that stablecoins can do that our asset can't, and there's things our asset can do that stablecoins can't. So there's a nice symbiotic relationship between those two things. If you want to know how the banks feel about this whole space, I mean, almost every bank we talk to is considering or building some kind of tokenized deposit, asset right now. And then that leads you to think, okay, if everyone has a tokenized deposit out there, who's the centralized clearinghouse that says that a tokenized deposit from one bank is the same asset as a tokenized deposit from another bank? How do they level those out? Like I said, is there some kind of centralized clearinghouse mechanism? Or do we just all agree that if it's a bank, it's fine? So there's definitely some things that have to be worked out as to how those all interact with each other. But I think that that's an attempt by the banks to be able to be engaged in this space and be able to, hold their deposit bases.
Well, I think they're going to have to get to the place where they're paying interest hourly as well, because they're certainly not in that space right now.
I think what you find, again, like once you start to engage in this space, the operational efficiencies are all designed around cutting out middlemen and trying to get people, again, this idea of like fully realizing the economics of your trade is something that we're deeply passionate about. So if I think about the middlemen who sit between me and my money everywhere and how they might be disintermediated by this technology, if I'm in one of those seats, I'm trying to incorporate this technology into my business right away to try and be able to figure out how I might be able to stay relevant in that system. And we're seeing everybody across the financial system engage in this space. Now, the tough news is there's going to be some businesses that don't do so great in this revolution, and there's others that'll do fantastic in it. But the good news is for all of us as investors and individuals is that we're all going to benefit as the whole system, the financial system that's underpinning everything, gets rewritten and rebuilt. And we're really excited about that future.
Yeah, so are we. That's why we're all in the space. But it is funny. There's still plenty of resistance, particularly here in Australia. So it's great to talk to people like yourselves that are early believers and early adopters and going into the space. We're about to take a quick ad break.
In markets or on the mountain, every defining move begins with intention. A split-second analysis can change everything. Because the perfect line isn't guessed, it's crafted, it's timed, shaped through precision, analysis, and confidence, with the tools that turn intention into execution. Scotty James finds his on Snow. Traders find theirs in Web3 with OKX.
And here we are back with Mike Reed from Franklin Templeton. Mike, FT's planning to tokenize some of their ETFs. Could you take us through about, one, what led to the decision and what advantages you see about tokenizing the ETFs?
Ondo has tokenized several of our ETFs now, which is great. We want to be able to have investors have access to investment ideas in any way, shape, or form that they might be wanting to do that. So we see this as kind of the next evolution. Even a token, you can think of it almost like it's a new wrapper for offering products. So we had mutual funds, then we had ETFs as a new wrapper, and now we have tokens with underlying beneath them. And it's kind of this thing where investors are just in new ecosystems and new places are able to access assets like these. So we're really excited about what's happening in that space.
How do you see tokenization changing the markets? Do you see all products trading 24/7 at a time in the future?
Eventually, I think so. There's some things in the marketplace that make it really hard to do that right now. Every time a fund trades, an NAV has to be cut and people have to figure out pricing and all of that. So there's some operational things that create challenges there for us in the traditional systems. But the great thing about this technology is, we say oftentimes crypto never sleeps. And so now the unfortunate thing is then neither do we. But, the good thing is, again, for all of us as market participants, these assets are available to move and look at. It's just 24/7. The question you have to ask yourself is, if you're trading in an odd time, is the market liquidity where you really want it to be, that you're going to get an accurate price for your assets? Or does it become, the side where somebody who's trying to trade into an illiquid market gets kind of brutal pricing on their transaction? And that can happen in traditional assets, let alone in some of these more interesting things that are being issued on chain. So I would say, yes, I think this all becomes a 24/7 market eventually, but there's a lot of wood to chop before we can get there.
Michael's my background was in foreign exchange, and Monday mornings, when something happened over the weekend, were always very interesting in the foreign exchange market. If you're in this time zone, it opens up at 5 a.m. officially on a Monday morning, and it can be brutal.
Well, I remember when Silicon Valley Bank failed and the Circle folks held a bunch of their reserves there. There was some interesting pricing on those assets over the course of the weekend, and our chats internally were very active about them, because you could trade and execute all weekend off of that news, even though all those assets were sitting in a traditional account, and everything ended up working out pretty well there, I think, for Circle, certainly in terms of their holdings. But there was a period of time there where you could trade those assets in a pretty active way, and made for an interesting weekend for sure.
I think the market's learned from that, because at that point in time, I don't think we could mint and burn, or no one could mint and burn directly with Circle on the weekend. Okay, and that's kind of why it broke the peg, or one of the reasons why it broke the peg. During the Signature Bank, I guess the issue that was going on with them, and the $3 billion hole that was coming through in the Circle assets. That has actually been, I think that's been corrected now, or it certainly has been by MacroPod. Drew, I'm sort of going to use this as an opportunity to go back. Can you actually just tell us a little bit about that? Because can we mint and burn 24/7 on AEDM?
You can redeem. Minting is still a manual process till June. So we do a quick check when someone sends us the money to make sure the money's actually in the account. But when you redeem, you send tokens to us. They, via NPP, they're back in your account in a minute. You can do that on Saturday afternoon, or as long as when you're on board, you've got an Aussie dollar bank account that's part of the NPP system. So redemption is automated.
So that's a really important thing, and we're sort of discussing liquidity here. And Drew, you asked previously about, the ETFs and how the market would, evolve into a 24/7 market. Having the stable coins active 24/7, being able to mint and burn, on the weekends is especially important in terms of facilitating that liquidity. Okay, so if we eventually, I'm hoping Mike's going to announce something big at some point in the future about having, potentially an ETF in Australia, which might be tokenized. And if you were doing that, let's say you need to facilitate that on ramp through AUDM, then we would need to be able to mint and burn through MacroPod 24/7. We'd also need that functionality from the Franklin's perspective to be able to make sure that there was liquidity in that ETF 24/7. So, Mike, you're absolutely right. There's some things to solve, but we're getting there step by step. On our side, we still, as you know, we're trying to move to tokenisation on a number of our funds. There's still some blockages there, which we're trying to punch through. So I noticed that you guys took 4 years to get to the Benji program being live. I'm hoping that we will now be able to cut that down. What are your thoughts, mate? I mean, how long before we actually potentially have this all working seamlessly?
Well, I think a lot of that time was spent, quite frankly, educating the regulators on how things were going, because our products have been built, full regulatory compliance. So in the case of our U.S. product, there's a SEC registered 2A7 government money fund underpinning that. In the case of our product out of Europe, there's a CSSF registered UCITS vehicle. So we have these things. And whenever you talk to the regulators about, there's two ways to approach the regulators. One is to be collaborative and the other is to be combative. And if you're taking a combative stance, you can just launch something and kind of say to them, now what? Our approach is way more collaborative, where in the case of Benji, we created webinars. We had a regular dialogue with them, educating them, provide a 24-hour hotline they could call with any kind of questions or anything like that, because it's super important to have full buy-in from everybody so that you can get permissions to do interesting things like issue assets authentically on chain, issue digital asset securities. And so that's certainly the preferred method for us, is doing it in that regulatory compliant way. I know right now there's a lot of constructs in the market where there's like an off-chain trust, and then again, you buy like a receipt token. The challenge operationally is, how do you keep the receipt token as close to the trust as possible from a pricing standpoint during those illiquid hours like you were mentioning? So you have to have participants in the marketplace that can help to kind of supplement that liquidity. It's a real complex thing to get done right now using the current regulatory framework that we have. Hopefully in the future, we'll be able to do it a bit more of the marketplace will be able to move in that kind of, authentic tokenization. But this opens up a whole other can of worms of being able to tokenize the underlying assets as well. And to us, that's the panacea, where you have a token wrapper where the underlying are tokenized as well. You can start to think of things like minting and redeeming in kind. So if I come to a fund that manages treasuries and I have a tokenized treasury, can I post that treasury to get fund shares, and how that would work? And does the fund then accept that treasury into their portfolio? So you can start to see, like, when I say there's a lot of wood to chop, there's a lot of wood to chop when it comes to figuring out how these things. Now I'm not even a basket of stocks. So I come in with those, all of a sudden it's like, okay, you have this basket of stocks. Do I have the proportional amount? Maybe, maybe not. How does that work from prices? So it starts to get, this whole thing starts to get very, very complex very soon. But the good news is that when we come out on the other side, we're going to have this lovely financial infrastructure that we're all going to be able to use. Wallets replace accounts, and all of our tokenized assets can live alongside of each other, whether they be securities, NFTs, meme coins, real estate, ownership in some physical asset, whatever it is, it can all live alongside of, each other.
I can easily paint that picture, and it's about 2031 or something, but the next 5 years is going to be a very mixed path in how we get to that space. But for me, it seems relatively easy to picture what the future is going to look like. There'll be people will get there at different paces.
It's really, clarity the market needs. I think regulatory clarity helps a lot. I think one of the things that's helped us here in the U.S. is the current administration. Again, this is apolitical, but the current administration is a lot more favorable to this technology than the previous one. And as people have seen some new regulations come to the market, some of the proposed regulations that could be coming live, that's given people a lot of confidence in being able to do some spend, quite frankly, and build this technology and see where things go from there. So it's a pretty exciting time.
It was a very similar thing here. We definitely took the same approach at Franklin Templeton. We did a lot of running around to the various regulators, and I think that's why eventually we were the first stablecoin license that was issued by ASIC in Australia. But there was definitely a change in regulatory attitude and post the new administration in the US, the various regulators here sort of got together and said, wow, this is real now. You had the Genius Act proposed, Clarity Act, just the proposing of those acts changed the mindset of various authorities here in Australia. And we definitely got to giddy up when that occurred.
Yeah, Mike, I've got a question for you. And this is going to have to be you're going to have to answer this from a personal perspective, not from a Franklin Templeton being apolitical. But has the Donald been good or bad for the digital asset sector since he's come in?
Look, let me say this again. I think the current administration has a much more favorable posture towards these assets and this technology. The American institutions are set up to protect these kind of regulatory bodies that govern our industry. They're set up to protect American investors. And I think the previous administration looked at this space and said, okay, maybe if we just push some of this offshore, we can keep it out of our investors' hands. But what happened instead was that the U.S. investors started to go offshore for those needs. What the current administration has realized is that if we bring the regulation back onshore and we provide a framework for individuals, but also for businesses who want to work in this space, it's going to create a much more friendly environment for these assets going forward. And people will at least understand what's happening. I think regulatory clarity is what everyone craves, regardless of the industry you're involved in. And we're no different in the digital asset space. So the fact that we've been getting regulatory clarity has been super helpful to all of us who are in the space.
Yeah, it's awesome here. We've got the Digital Asset Act coming. We've got the Payments Modernisation Act coming. So there's real clarity coming to Australia. Some of it's here, and it will play out into our industry over the course of the next 12 months. It's layered in. And then we've got payments modernisation. So that will include exactly what is a stablecoin, what is a tokenised deposit, exactly what reserves you're allowed to hold. So we're going to get that clarity here in Australia over the next 12 months, which I think is absolutely fantastic.
Yeah, well said, Drew. Mike, I was actually contemplating that question myself and how to answer that. I think the way you first started to answer that question in terms of the market level is actually quite a good response because, when Trump came in, Bitcoin was around 65,000. Now it's around, so let's say 76 type thing, 76,000. So it's definitely improved. There's been times where everyone's sort of been very excited and has moderated. But I think for the US, it's definitely, when I look at the needle, has he been good or bad? He's definitely been good. And when, as Drew said, when we talk about Australia and the other jurisdictions, the ripple effect of what the Donald's done, has had a material impact, and it is driving all of the countries around the world. So I've definitely got him in the positive side.
Well, it's interesting at different points in my career doing this. So I've been doing this for almost 10 years now in the digital asset space, and was doing fixed income before then. When I was doing fixed income, I was a pariah at cocktail parties. And then now that I'm in crypto, depending on where you are in the market cycle, it's like really interesting or not. I would say, this is all anecdotal, of course. I would say since the new administration came in, people are a lot more interested in talking about our industry because it feels a lot more legitimate to them than it did before. I mean, I work at a publicly traded company, super heavily regulated. So everything we've done has been built in that way. So we've always felt like a super legitimate, effort in the space. But now kind of getting that recognition from even social peers has been kind of nice.
Awesome. So what's the success look like for Franklin Templeton in 3 years' time?
Yeah, I mean, you asked about products earlier. I would say product proliferation. We want to be able to have a lot more things on the shelf for people to look at in this space, whether that be new tokenized vehicles, but also vehicles that invest in tokens themselves. And because I think when you first start in the space, and remember with me back when you were first looking at crypto, it feels like Bitcoin is the same thing as Ethereum, is the same thing as Dogecoin, is the same, they all feel the same. All these assets feel the same when you first take a look at any, a website of the pricing. And then you start to dive and you learn about the economic models of them. You learn about the fact that there's real revenue being generated by certain tokens. You learn about the protocols themselves and these real interesting novel businesses that are built on top of them. So if you can find a way to, do some analysis on those and come up with price targets, it becomes an interesting investment. So I think we have stuff, like I said, both on the tokenized front and then also products that invest in tokens. So first would be product proliferation is something. And then the other thing that we're trying to do is we're trying to be engaged in as many ecosystems as we possibly can in a thoughtful and meaningful way. And so what I mean by that is that, we run validator nodes. We run about 30 nodes across about 11 chains. Part of the reason that we do that is because we think that it should be table stakes if you're running a product on chain to have your own copy of the transaction records. But the other reason that we do that is because just as stewards of this new technology, we feel like it's important to participate in the ecosystems and help to secure the networks in which we participate. So continuing to proliferate in all of these ecosystems, I think is another thing that we're trying to do. And all these different constructs that are out there in the digital asset universe is, something we're deeply passionate about.
Look, Mike, that's been absolutely awesome. It's for our whole industry. It's great to have pioneers like Franklin Templeton. Chris and I wish we had a couple more of people like you here in Australia. We're just going on our journey, starting our journey in the traditional funds management sector. It feels where your traditional sector is starting to get interest in the space because because they've seen that the regulation here is coming. There hasn't been any pioneering pre-regulation from the traditional sector.
I'm going to interrupt you for a second here. I mean, the reason I know both of you is because of the work that you all do and some of that pioneering work that you do. So there are pockets for sure. You just kind of have to find your people and, cultivate those relationships. So, maybe give yourself a bit of a pat on the back.
Absolutely. Mike, thank you very much. And Credit, thanks for joining us today. It's been a real pleasure.
Thanks for listening to the show. If you want to find out more about what we do at JellySea, the links are in the episode notes. And if you can rate and review the show on your favourite podcast app, that would be much appreciated.
This is a Piccolo podcast production.